Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh of Macro Tides with us, and he's here to break down all the big themes in the market this last week. He's hit with us every week. It's great to have you, Jim. Let's bring him on in. Jim, how are you?
I am good. How are you doing, Blake?
Good. We just came off of CPI and PPI week.
Yeah.
A little bit of mixed signals, but you know what's interesting is following the CPI, the dollar didn't really respond. Stocks didn't really respond. Stocks actually held its bid. Dollar
Yeah.
didn't get any rally following the stronger report. Producer prices come in a little weaker. Dollars sold. Stocks hit 4,800. It's like it feels like that balloon, that balloon that's like, or a beach ball that's full of air, and you're trying to push it below the water,
Yeah.
and it's just not
Yeah.
going down. Tell us
Yeah.
how you're reading this inflation data that we got this week.
Well, you and I talked about it last Friday, and we showed a table of the CPI going back really about 13 months. And the point was that it's a rate of change. So you subtract the number coming off from December of 2022, which in this case was a 0.1. And the point I made was we're not going to see much change here like we've been seeing over the last 6, 9 months because that is such a small takeaway value. And what happened in terms of the headline, the takeaway was 0.1. The month over month came in at 0.3. Well, that's why the headline went up. But as I pointed out last week, the core takeaway was 0.3. And so there was some rounding stuff. So it went from 4 to 3.9. So the whole point of last week was people have been getting spoiled by these declines in the CPI over the last 6, 9 months, and they're not going to get a similar experience. What we also talked about was that coming in January and February, the takeaway values from January and February of 2023 add up to 0.9%. So big takeaway values relative to what we saw in December, the CPI, both core and the headline, are going to drop over the next 2 months. So I just thought there would be some short-term consternation from a standpoint that, people have been thinking that, gee, it's the decline in inflation that is motivating or will motivate the Fed to aggressively cut rates. And the idea was, you know what? They're not going to get the fodder that they've been getting. The numbers are likely to come in kind of ho-hum, which they did. And the PPI kind of resurrected because this is, if you think of a pipeline, the PPI is at the beginning, the consumer prices at the end. And so the PPI coming down, again, suggests that going forward, we're likely to see that's going to contribute to less pressure, upward pressure on prices.
So how's that going to factor in, and what's your feeling with PCE coming up, because that's the Fed's, what's their
Yeah,
their
it's going to drop. I mean, not hugely, but it's going to drop. And, over the next few months, the PCE has a better chance of coming down more than the CPI. The point I made in the January macro tides, because I went through all these numbers, both the CPI and the PCE, is once you get past February, the takeaway values from March through, I think it was July, are small relative to January and February being pretty big. Because both on the CPI and the PCE, Blake, it's 0.9. Big takeaway values. All of a sudden, it drops a fair amount, more so on the CPI than on the PCE. So my only point is, as we go out and get closer to mid-year, both of the inflation metrics are going to soften in the first part of this year, and then it's going to be a grind in terms of getting them much or appreciably lower between now and July. In other words, the month-to-month numbers are going to matter more because the takeaway values shrink after we get past February.
Well, Jim, the first chart, and I'm gonna bring this up because I think it's important, in terms of what we're discussing right now. The first chart you brought up is the Atlanta Fed wage tracker. So tell us a little bit about this chart and
Yeah.
why this is important.
Well, people are looking, Wall Street's looking for 6 rate cuts. Okay. Why? Because inflation's down. Is that good news? Absolutely. Is that the only determinant of monetary policy? And as I wrote about it in the January macro tides, I think we've talked about it. You got two groups now on the FOMC. You've got the doves that think, gee, inflation's come down. we need to cut the funds rate, because if the funds rate is at 537, call it, and inflation drops by 3/10, well, and you haven't done anything with the funds rate, it's as if the real funds rate has gone up by 3/10. So that's the argument, if you will, being made by the doves. The patient hawks are like, you know what? I want to see more data. And I think one of the unsaid things, for obvious reasons politically, is seeing the labor market soften a little bit more in addition to the overall economy. So if we look at the Atlanta wage tracker, you can see from 2016 until the very early stages of 2021, it was hovering between 3 and 4%. That's when the PCE and the CPI, they were, hanging out around 2% plus or minus. So the point being here is, if you look at it at 5.4%, we're way away from 4%. So and these are points that you and I have talked about kind of maybe ad nauseum for some people, but it's important. The Fed, if it looks to cut rates, yes, on one hand, we're going to keep the real funds rate from going up, but we're going to be providing stimulus to the economy. And what this says is that wages are not commensurate with inflation closer to 2%. So that's the patient hawks, in my view, is they're looking at this and like, you know what? I need to see more progress on wages before I'm going to be comfortable adding stimulus, because if we do it in 2024, the odds are there will be upward pressure on inflation in 2025 and 2026. And so that's where their, I think, focus is. And a lot of people made a big deal out of Lori Logan, who's the Fed president out of Dallas this week. Like, she gave a speech over the last weekend, and she talked about, you know what, we may have to cut back on the QT part of what the Fed is doing. But she brought up some of this stuff. And she also mentioned financial conditions have eased significantly, which are going to make it tougher for us to achieve our goal.
Right.
And so I haven't heard anybody on Wall Street talk about that comment. It's all been, well,
it doesn't fit their narrative, Jim. It doesn't fit their narrative.
Nope. And therefore we delete, So again, this is important, because how is monetary policy going to progress in 2024? And this is a chart that I think the patient hawks would be, you know what? Let's wait a little bit, because we need to see wage growth come down before we add more stimulus to the equation, because the financial markets have already added a lot of stimulus, with treasury yields coming down, 2 years down, stock markets up, dollars down a little bit, so there's more nuance to the whole conversation, or there should be, as opposed to, oh my God, inflation's down, the Fed's got to cut. That's just, in my view, overly simplistic.
Well, let's what's this next chart that you brought about unemployment?
It just reinforces this point, is that this goes back to what, 1960 or something? I don't know. It's
1950 actually.
Yeah.
40s.
Yeah. Wow. Okay. So what we can see is the unemployment rate is near, all-time lows almost. Basically, it's like the near the lowest level since somewhere in the 1960s, right? And so this just reinforces that the labor market is still tight, at least from the Fed's perspective. They're seeing evidence of that in terms of the Atlanta wage tracker, in terms of what's happening with wages and how stubborn they are in terms of coming down. I mean, they are going to come down more. However, it's the pace of the decline that will dictate, I think, how the patient hawks react. The other point I wanted to make up, what we can see, and if I had a chart of the CPI, you would see the biggest declines in inflation have occurred during recessions. That makes sense. You wipe out demand, you're going to see price pressures, vaporize.
That makes sense.
And so again, I just think that if some takes a longer term view, and I think some of the members of the FOMC are looking out over the next 3 years, not the next 3 months, that all of this adds up to the patient hawks are going to be willing at some point in time to toss a rate cut in. It's not going to be, okay, let's cut in March May, June, July, and that's what Wall Street has priced in. I just think that sets up the table for disappointment.
Well, before we get into the charts that are
Yeah, market
meaningful to the
related.
markets and how the market's going to take in all this data, I do want to say this. If you enjoy what Jim does every week, make sure you give him a big thumbs up. Jump down in the comments below, especially if you got, macro is funny. Everybody's got an opinion and everybody's got their ideas of which way they believe unemployment's going to go and how that's going to affect the economy. Jump down in the comments below and get in a conversation with Jim. I'm sure he'd love to hear your views as well.
I respond to comments. I look for them. I appreciate them very much. Again, I'm always happy to answer questions because I appreciate some of this stuff, to the foreign currency crowd, if you will. Some of this stuff may not seem that important or they're not that familiar with it. And so to me, it's important because obviously it is going to impact how the Fed progresses this year. Well, given where expectations are, the bar is really high, in terms of what people are expecting the Fed to do. So all I'm trying to do is say, you know what, that is completely unrealistic. How are markets going to respond? And that's when then looking at technical stuff can provide more substance in terms of, okay, are the markets happy with what's going on, or are they beginning to get disappointed? And that's why I think the blend of technical with fundamental is imperative.
Well, we're going to get into that right now, but I do want to say this: as far as the markets go, they seem to be oblivious at this point. Markets are still very strong, and the first chart you bring up is the Russell 2000. So tell us what you're seeing here.
Yeah, well, I just I listen to CNBC, have it on in the background pretty much all day. And I hear people come on and they're like, well, okay, we're not going to have a recession. And so we want to look at the cyclical orientated stocks, and Russell 2000 small caps are part of that equation. And these stocks are, on a relative basis compared to the Magnificent Seven are, really cheap, blah, 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 blah. Okay. So technically what we can see is you had a breakout above 3 prior kind of important highs. And people jumped on that. Well, look at what's happened since in the last week and a half or so. It's immediately dropped below. That looks like a failure from a technical standpoint. The other point I would make is the Dow has made new all-time highs. I think one of the NASDAQ averages has. The S&P's got within about 16 points this morning. Okay. Yeah. But look at where the Russell 2000, and now this is IWM, the ETF. But the percentages, we're talking 40, almost like 18 to 20% below where it was in 2021. And if we looked at the value line composite and other broader averages, we would see this huge divergence between making a new all-time high and where they are today. And it's that dysfunction underneath the surface of a market that, to me, needs to be monitored at this point in time because it shows fractures underneath the market. So we talked last week about the 17-year cycle, how we've seen the S&P top every 17 years, the last obviously being 2007, 1990, 73, 56, and 39. And to me, this is one of the things that adds credibility to that cycle because we're seeing this kind of fractured nature within and underneath the surface of the market. So that's why I thought showing this, and it's a counterpoint to Wall Street, we really like those small caps. They're cheap and blah, blah. And okay, well, the technical action does not look healthy.
Yeah, Jim, I come from the school of thought, and you probably do as well. Look, when you see stocks underperform, I mean, it's fine if the markets rally. You're going to get an index like the Russell plane.
Maybe 70% of what the S&P did. Okay, well, it could have been better, but
right, it's going to play catch up. But if things turn sour and you really start to see a pullback in equities as a whole, the underperforming index like the Russell 2000 is going to be the index that's probably going to suffer the worst. It's
not about to do change its stripes.
Right. I mean, if you're going into a rotation period where stocks stay you get just normal pullback. You might get a little rotation, but if stocks are not in favor anymore, they're really going to hit some of these weaker indexes like the Russell. I think the Russell underperformance is going to speak volumes when it trades back to that range low. And you're
Yes.
right. Wall Street's idea right now is that the Russell 2000 is going to go much higher while the rest of the stock market doesn't do anything. So,
And maybe it will, but to me, the proof is in the pudding. It
yeah,
needs to take out that high at 205. I mean, on the IWM.
yeah.
The other thing is, if the economy slows later this year, as I think likely as we get closer to mid-year, that's not a positive for the small cap stocks. They typically underperform. So that's another reason, if you will, of again, the other point people have made is, well, the market's broadened out. Yeah, it did for a while. Well, this is an indication that, it's like take a deep breath and our chests expand and then we exhale. Well, the market's been exhaling.
Yeah.
And the next chart shows that even more, I think, directly. All right, so we have the S&P 500 on the top. The bottom is an oscillator. It's a 21-day net advances and declines. And to me, this is a good intermediate indicator. 21 days is about how many trading days there are in the average month. And the point I'm showing here is you can see the S&P made a higher high today by a small amount. At the same time, look at the oscillator, how much weaker it is. Now, if we go back to last July and August, what we can see is, as the S&P was making a higher high, getting up to 4607, the oscillator was weakening. Well, the weakness that we've seen in the last 10 days is more pronounced than that. It doesn't preclude, that the S&P can't push and get above 4818, which was the all-time high. I still think that's coming, but seeing what's happened to market breadth under the surface, what's happened with the Russell 2000, to me just says, hey, folks, what I've talked about is I think the S&P is getting above 4818, and then at some point in time in the first quarter, there's a 3 to 5% correction coming. Well, these are all signs that the internal strength of the market is really starting to throw yellow caution signs.
Jim, I always think about the 4,900 level that you threw out, around the holidays before the Christmas holiday. But what you're pointing out here, and things change. I mean, you take it week by week, day by day. You take in the data that you got, and right now, based on what you're telling me, 4,900 might be a stretch. It would be difficult to do.
Well, it may happen after we get a deeper pullback than what we've seen. And I think, as I said, 47.35, that was the low a couple of days ago.
Yeah.
And it's kind of like, okay, maybe this is a B wave up here. In other words, the decline down to 46.82 was an A. Yep, we got up a little bit above the prior high is a B, and we're going to get a hit job under 46.82 before we get that push higher. And I just think this is a warning that the market is weakening. It doesn't preclude a move to a new all-time high or even to 4,900. It just tells me is that, risk levels are rising, and it's time to become more cautious. And maybe you miss out on 1% to the upside, but the probability of that 3 to 5% correction coming, I think is increasing.
All right. Well, the next chart you have is the 10-year. So how do you feel about this, Jim?
I think treasury yields are headed higher.
Okay.
I just, I think you can count 5 down from what we saw in October. That means that we're going to get a retracement of that 120 basis point decline. I think the wave 4 of lesser degree around 429. That's where that number 4 is. The high was 429 then. I just think the odds are treasury yields are going to tick higher. We're not going to get the kind of cuts that Wall Street's expecting. And I don't think the economy is going to roll over here yet. I think we're going to continue to see it chugging along. And that combination, I think, is a backdrop to higher yields. In the meantime, the supply of bonds continues to be ample.
Yeah. But from what I understand, the bond market, there's record shorts in the bond market too, which
Yeah,
probably will prohibit, yields from going too high.
right,
Would that be
right.
a safe assumption there?
Okay, here's the bigger picture. That 5 down in the 10-year,
Yeah.
but for me, what that implies is, okay, we're going to see yields back up, but we're likely to see then another big decline in treasury yields. And I've said this before, I think the 10-year will get below 340. Again, my assumption here is the economy is going to slow more than what people expect. And that is what's going to bring treasury yields down. So to me, what's happening in the expectation that yields are going to tick higher is nothing more than we get a retracement rally of this 5-wave decline. But that 5-wave decline implies that after this retracement rally, there is another decline coming. And from a multi-year perspective, this will amount to a big ABC. And once we get down to 340, I think there's a shot that the 10-year will get to 550, 6%. So big picture, it's to me bearish for treasury bonds. But over the next 6, maybe 9 months, I think there's another trade on the long side. But first, I think we're going to see treasury yields tick up. There'll be a nice rally. And then you really want to get out of Dodge.
Well, then
Because,
that means that the dollar, you must still be fairly constructive considering the very strong correlation
yeah,
between 10-year yields and the US dollar.
correct. I believe that the dollar is going to make a move up to the 104 level. We're not talking about anything earth-shattering. There could be again a dip below the recent low is, I think, what did I have up here? 101.90. So that you had this push up, we went down, we bounced a little bit. Okay, you get down below 101.90, and then you push up towards 104. However, the dollar is kind of like the bonds. I can count 5 down from that high at 107 and change. What that implies to me from a bigger picture standpoint, that this rebound is counter trend. And let's say we get up to 104. Then I think the dollar is going to make its way down to 96 at some point in time in 2024. Again, the fundamental backdrop from my perspective is the economy is going to slow more than people realize. So the idea that the Fed's going to be cutting rates 6 times because inflation's low, I think is out to lunch. Will the Fed respond to the economy slowing materially? Absolutely. So, it's just we're not at that threshold yet where things tip. But again, the take here is the dollar moves up. Bigger picture, I think the dollar is going to have another pretty significant leg down. And to me, all these pieces are fitting together. Now, it may make a pretty ugly picture, but then again, that's what we're here for.
Right, right. Well, the last chart, and I'm sure a lot of people want to see this, is gold. And
Yeah.
I'm gonna tell you, Jim, and I know I've said this. I believe that move here to that resistance was a false breakout, and we're gonna eventually make our way lower. But I don't know. Do you
Yeah.
still see the same, or do you? And that doesn't mean I'm a gold bear. It just means
Yeah,
I
right.
think we can get at cheaper prices. But
Yeah.
what do you think of what are you thinking here?
I think we're going to get a pop up. Well, again, as long as we hold that trend line,
This one right here.
that's important. Okay.
And that
I
was
think
tagged yesterday following
yeah,
CPI. So,
right. So I think that there's a tick that is going to trade above 21.22. And my take here is that will be a high that will last for a while. And then I think we're going to see gold trade. So your assumption that will you be able to buy it cheaper than where it's trading today? I think so. Ultimately, I think gold's going above 2,300 in this year. But I just think that potentially we get this pop up here, and then there's a decent size correction. I don't know if it takes us below 1974. or 1933, I just think that the odds are we're going to get a high registered, then a decent sized pullback, and we'll take it from there. So, for weeks I've been saying, well, I think we're going above 21, 22. It's been laborious. And I've been, to me, the weakness in the dollar, I would have expected gold to run more. Now, maybe what we've seen, and we've talked about this a while ago, but Bitcoin has fascinated people. And I think some of the money that historically maybe has traded gold has shifted to Bitcoin.
100%.
So maybe,
yeah.
So maybe what's, the idea of the ETF coming and, oh my God, we finally reached the promised land. That is all the earmarks of a multi-month high, in my opinion. And so as that evolves, maybe that some of that money then gravitates back towards gold. But just taking the chart of gold on its face value, a move above 21, 22, and then I think we're going to get a correction, and we'll just have to gauge as that correction proceeds when the next buying opportunity presents.
Well, if it makes you feel any better, my young men, teenage boys, my men children that I have are not talking
Eating you
about
out of house and home.
they're not talking about crypto like they did during the peak when Bitcoin hit its highs before. So there's that. Let's keep it in
What's
perspective.
interesting, I don't keep track, and I'm starting to pay more attention to Bitcoin because it's a heck of a trading vehicle.
It is very technical
but
too.
I'm guessing that the sentiment now is almost as bullish as it was when Bitcoin was at 65,000.
Yeah.
That was the other high. So here you have a high that's significantly below the prior high, and yet the enthusiasm level I'm assuming is comparable. It'd be interesting. Somebody's got
from the street's perspective, it is. I think the street wanted to get more public support. And like I said,
Right.
My teenage men children that are, in their late teens aren't talking about it. So therefore that might leave in the game of musical chairs, Wall Street might be looking around going, shit, where's my chair? So, you know what I mean?
Yeah.
So,
I mean, it's kind of like, okay, how hard can we push this to get as many dollars into the buckets that we just created?
I think that was a new Wall Street vehicle has been created, and they may not be garnering the support they had hoped. So
but it'll take a while. I mean, again, a lot of times these tops, you get the spike high, you come down, and then all these people who've been wanting, but I'm not going to buy that spike. I'm too smart for that. They buy that what would potentially be a wave 2 or B wave prior to, oh, it's not really going to keep going up. Oh man, I'm bummed, and you get another pullback. And that's what I think is going to happen to Bitcoin. There's another good buying opportunity coming.
I think so.
But it's, for me, it's just, this is classic sell the news.
I've never seen so many crypto people that I've never seen in suit and ties over the last 2 weeks.
Well, it's respectable now, Blake.
Which is interesting. When you talk about a community that is notoriously sweatshirt and baseball cap,
proud of it,
and they're all suit and tied up the last couple of weeks. I'm like, I don't know if the public's falling for that one, but anyway,
like the inverse of the mini skirts back in the 60s, marking a top. That was an indicator, like the hemline indicator. Well, now we've got the fashion statements by Bitcoiners.
There we go. All right. Well, anyway,
like that.
Needless to say, Jim, it's always fun catching up with you. And if you guys and gals enjoyed this episode of our show with Jim, make sure you give him a big thumbs up, subscribe to the channel, but hit the bell icon. If you hit the bell icon, you're notified when a new video comes your way from Jim Welsh. So, Jim, how am I supposed to follow you as a trader? What's the best way?
Go to macrotides.com. And if you would like to receive a recent publication, Jim Welsh Macro at Gmail, and I'll send that out. I have a piece that I discussed the 17-year cycle in detail, and I think that's going to be fairly relevant this year. So, people should become a little bit more familiar with it.
And if you didn't catch last week's episode, Jim did brush just a little bit on
Yeah.
that. So
yeah, we hit the high points.
yeah, so
Oh,
make sure,
that's a pun, right? Because it's a 17-year cycle on hot. Okay, never mind.
I got it. I
Sorry.
got it. It's Friday. We're going to laugh anyway. So Jim,
Yeah.
thanks so much for joining us. I look forward to our conversation next week.
Thank you, Blake.
And thanks everybody for listening in. We'll see you then. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.